This would be my main argument as to why the last 10 years has been really abnormal. And you can see here in the chart on the left that the correlation between central banks' balance sheets and global stock markets is about 0.95 in the last decade. There has been one driver. It's nothing to do with the economy. It's nothing to do with profits. It has just been that people have been squeezed out of fixed income into other asset classes, into riskier assets, and that's driven equities up. The reason, obviously, that life's getting a little bit more difficult is with inflation taking off, etc., and central banks committing to start to shrink the size of those balance sheets rather than grow them in perpetuity, that life looks like it's going to get a little bit more difficult. The chart on the right, and this is for the US market, again is interesting in terms of underneath equity markets, what's happened with that massive intervention in equity markets. And what you can really see is that multiple expansion, or the multiples that get accorded to particularly the higher end of the market, the growth, the quality, the market darlings, if you like, have really gone higher in the last, again, exactly the same period as this. That expansion of multiples, being prepared to pay for earnings into the very distant future, has really been the unusual factor of markets in the past decade. At the other end of the market, the value end, for want of a better word, you've seen almost no change. Multiples haven't risen for that end of the market. It's just been about that separation. This, to me, is a really interesting backdrop, though, and probably, again, predates almost the global financial crisis, and in part sort of goes back to why it occurred in the first place. And that really is this long-run separation between wealth, or the value of assets in stock markets, and GDP, or the revenue of the economy. So, interestingly, you can see there in both the US markets, and I've ripped off this chart from Ben Hunt at Epsilon Theory, but we've recreated the same chart in Australia, and you can really see that household net wealth, or the feeling of how rich people are because of their asset base, has really separated through that long period. And again, the period since the global financial crisis has really been the epicenter of that separation. Why do I think it's important? Well, I suppose you've got two questions. Do you think this can happen forever? Can we separate the value of assets from the revenue and the cash flows that justify those valuations perpetually? And where I come from, the answer to that is a firm no. An asset has value only because it gives you a cash flow stream. And we've forgotten a lot of that in recent times, and that is why we've got this separation. In part, it's driven by some companies where people think that they will be these massive streams of profits into the distant future, and it's okay to pay for them now. And it's also about just paying much higher prices for the cash flows that are there. And obviously that was driven by central banks again with taking interest rates to zero. So that separation to me is a big deal, and one way or the other, I think there has to be a closing in that gap between the two. Just lastly, again, in going to the characteristics of market and what's worked in portfolios over the last couple of decades, again, I'd point out that you go back to that chart I showed you on central bank intervention. Value underperforms growth, that bar at the end, exactly the same parallel. Value did badly basically at exactly the same time that interest rate reduction and central bank intervention took over, and we justified high multiples and growth won. The blip there that you see in the last 12 months where value outperforms growth is just that. It's a blip in a pretty long-term pattern, and you can see there that these normal cycles where it wasn't as pronounced and it was a bit more of a tug of war between cheap and expensive. It was a lot more stock specific rather than thematic. That has really disappeared in the last decade, and it's why I'd urge you to rethink the structure of your portfolios, particularly when you've got index. Index means you have a lot of exposure to those things that have won. And people often lose sight of that, but the US market, Apple, Google, look at the map of the market in the US equity market. Apple and Google are bigger than the entire energy and basic materials sector put together. We have lost sight of the fact that there have been massive restructuring in the market cap of markets and what we believe the future is going to be. And a bit like that inflation expectations chart, we tend to put a lot of emphasis on what's worked of recent times. And I'd urge you to look a little bit at the longer spectrum of history in terms of the ups and downs rather than putting a huge amount of focus on the near term because, again, as I said at the start, I think that is the aberration.
Yep, and look, and so I'd like to focus a little bit more on the long run path of rates, and I think to me, we're investing with a 5-year time horizon typically, and so to me the question of 50 or 25 this month doesn't really make too much difference. The bigger question is where do rates end up as a terminal rate, and what's really surprising me at the moment is if you look at the dynamic between Australian rates and US rates, it's important to recognise there's a couple of major differences between those markets. Firstly, in the US market, you've got a fixed mortgage rate market, and that means that the vast majority of people would have fixed their mortgages for 30 years during the recent decline in interest rates. And they probably fixed them at circa 2%. So really what's happening as the US raises interest rates, that's hitting the new house purchaser rather than all their existing mortgagees. Now, compound that with the fact that Australia has much higher levels of household debt as well. And I find it really surprising that we've got the bond market pricing Australian interest rates actually more aggressively than US interest rates. So we've got a completely different structure. In Australia, those interest rates hit home immediately on everyone. Well, almost immediately when all our short-term fixed rates start rolling off in the next 12 months. We've got a much more highly leveraged consumer, and we don't have the same degree of inflation challenge here as we do in the US. So if we're looking around the world, we think that the Australian market has got a little bit out of whack with the bond market in the US. And so, as a former bond trader before I moved over to the equity side, I hate to say this, but I tend to agree with the economists rather than the market at the moment.
Maybe I'll take a slightly higher level view, just to change it up a bit. I think the most interesting thing to come out of this reporting season, and it was a reporting season that in aggregate more or less hit expectations, maybe slightly beat it, although with some divergence within that, was that it really validated the fact that these financial conditions changing have affected businesses, but what we haven't seen yet is a really significant impact that you might see in a recession. And this all comes down to that interesting dynamic that we have at the moment, particularly say in the US, but we're also starting to see it in Australia, where real growth is very low or potentially negative in the US, but unemployment's still extremely low, tight labour markets, demand is still high. Those impacts of a potential inflation haven't hit businesses yet, and they certainly didn't hit in the sort of last 12 months. So revenues were strong, cost pressures are obvious across most businesses. That's probably why we saw higher quality businesses outperforming. Ones that have higher margins to begin with are not going to be squeezed by cost pressures as much. Obviously, Australia has benefits from being a commodity exporter, and hence our market outperformed most in the world around reporting season. But the question now is, those things have mainly happened. What is the impact going to be in a real sense? So is the widget maker going to be selling less widgets now, rather than is the widget going to cost more to produce? That's a real uncertainty. I don't think anyone knows the answer to that. We still have expectations of EPS growth in the 4s. That's potentially a little bit bullish, I think, and even that is slightly below trend. So I think we'll start to see those come down over time as people digest the fact that what we've seen thus far is a financial shock more than anything, and what we probably will see in the next 12 to 24 months is an actual recession.
I'd sort of jump in on that, and that point of being really careful in where you're investing. So US growth, where are the opportunities there? That's probably more in a high quality tech basket. You know, there is now a real cost of capital. These established businesses, really strong businesses. There's something out there that's innovative and perhaps coming out of a 5-year view 5 years ago of I'm going to dominate the market, winner take all, I'm just going to grow, I need capital. Well, how does that business survive? And I think the disruptor actually becomes acquired and that high quality tech basket. You wouldn't necessarily think about cash flow, but they do generate quite a lot of cash flow. From an Australian standpoint, yeah, exactly, into that resource, green, metals, cash flow generation, you know, resilience to that cash flow generation. Within the fund that we are running, we have an ability to collar, so protect on the downside, but give up some upside. And doing that with an income focus, with some franking credits. From an Aussie equity standpoint, that makes a lot of sense. Be aware of China for sure. And these sort of sessions and some controversy, I'll put out their REITs, listed versus unlisted market. We've still got cap rates, you know, holding up in unlisted. The view, I think cap rates have, you know, really very difficult to see them going lower. But for those managers who are going to be active, are going to roll their sleeves up, actually create properties with high amenity, high functionality, great location, you know, that's where there's going to be value created, all of which supported by, again, really strong tenancy, inflation or strong linkage in their rental component. So I think those really high quality assets and infill logistics, which is part of a pivot we've seen through COVID, I think there really are opportunities there. Absolutely be selective. And I've expanded from Aussie equity sort of to Aussie A-REITs within those highest quality ones. And know your customer. Know your customer. What does this business do? Who are their customers? Who's buying a $4,000 iPhone? It's probably the same downsizer who's going and buying furniture from Nick Scali. Not on credit, but, you know, just know your customer and be selective.